Have you ever been tricked by a door that looks like it opens one way, but then when you push, it doesn't move? You step back, embarrassed, and realize you got fooled. That exact feeling is what traders experience in the market during a fake out. In trading, a fake out happens when price appears to break through support or resistance, but then quickly reverses and comes back inside. It's like the market saying, just kidding. Why does this matter? Because fake outs trap traders. Beginners see the breakout, they rush in with excitement, and then the market whips against them. Their stops get hit, and professionals who wait there patiently are the ones who profit. Let's use an everyday example. Imagine a soccer player faking a kick. They swing their legs like they're going to shoot. The goalkeeper dives, and at the last second, the player changes direction. That's a fake out, tricking one side into acting too soon. Now, where do fake outs usually happen? They tend to appear in ranges at the key support or resistance levels. Price builds up pressure, pretends to break, lures traders in, and then slams back to the opposite way. The psychology is simple. Imagine sellers defending resistance. Price pushes through and breakout buyers jump in. But if there isn't enough real buying power, sellers hit back stronger, and the buyers who got in late are forced to close. Their panic selling fuels the move down. That's how fake outs feed on impatience. How can you avoid falling for fake outs? Here are 3 simple filters. The first one, wait for a candle to close, not just a wick. Many fake outs are just quick spikes that never close outside the level. The second, watch for retests. Real breakouts often come back to test the broken level and then bounce in the new direction. Fake outs usually fail the retest. The third is check the context. If there is strong volume, momentum, or news behind the move, if not, the breakout might lack fuel and be more likely to fail. Another everyday analogy. Imagine kids playing tug of war. One side suddenly lets go the rope. The other side stumbles backwards thinking they won, but really they just got tricked. That stumble is exactly what happens in the market during an actual fake out. Here is a practical trading example. Euro USD has been stuck between 1.0800 and 1.1000. Price pushes above 1.1000, triggering breakout buys. But within 2 candles, it drops back below 1.1000. That's a fake out. The smarter move is not to chase the breakout, but to wait. If price falls and closes back inside, you could even trade in the opposite direction with a stop just above the fake outs. Why are fake outs so important to understand? Because they are part of the game. Big players know where retail traders set stops just above resistance or below the support. The market often hunts those stops, creates a fake breakout, clears the liquidity, and then moves in the other way. So what's the lesson here? Patience. Don't jump in the minute price touches a level. Wait for a close, wait for a retest, and always use confirmation. Think of yourself as a fisherman. If you throw your net too early, you miss. But if you wait until the fish actually swims into position, your catch is bigger and safer. So let's recap. A fake out is when price pretends to break a level but quickly reverses. It traps impatient traders, wipes out stops, and often fuels the opposite move. To avoid them, wait for candle closes, look for retests, and check for momentum or volume. Remember, the market loves to trick those who can't wait. So, in short, a fake out is the market's way of testing your discipline. If you learn to spot them and wait for real confirmation, you won't just avoid traps. You can even turn them into opportunities.